Hi everyone, welcome to our session on banking. Today we will learn three big ideas: CRR, SLR, and Money Multiplier. So let's start with it. So let me ask you something. When you put your salary or pocket money in the bank, do you think the bank just locks that money into a safe? Most people think so. But actually, bank use that money to give loans. But here is a twist. Bank can't lend all of it. They must keep a part of it of your deposits with RBI. This is called cash reserve ratio or CRR. Think of it. If CRR is 10% and you deposit 1000, how much will the bank keep with the RBI? It's 100 rupees. That leaves 900 for the bank to lend further. Now comes the exciting part, the money multiplier. That 900 gets spent, redeposited, lent again and again, multiplying money, which will multiply money in the economy. Now let's walk through a real life chain now. Suppose you deposit 100 in bank A, say 1000 in bank A. So bank A will keep 100 with RBI and lend rupees 900. The borrower spends 900 at say any shop, Mina's shop for example. So Mina will deposit 900 in her bank. Her bank will keep 90 again and lend further 810. So Ravi borrows 110, 810 and spends it and get deposit again. It keeps going on and on until the leftover amount is too small to lend further. This is how the 1000 deposit can generate almost 10,000 in a money supply. Here is a shortcut to calculate the money multiplier. It's the inverse of 1 by CRR, right? So, if CRR is 10%, multiplier is 10. That means 1 rupee deposit can become rupees 10 in the economy. Suppose, for example, if CRR goes up to 20%, what will be the multiplier? It would be 5. That is because higher the CRR, the less bank can lend. So, money creation slows down. Now let's move on to the SLR, which is Statutory Liquidity Ratio. Think of it like a secondary safety rule. Here, bank must keep a portion of deposit in safe assets like cash, gold, or government securities. So the question arises, who keeps this money, the RBI or the bank? It is the bank themselves. Say for example, again, there is a deposit of 1000 and SLR, we take an example of 20%. So bank invests rupees 200 in these safe assets and remaining 800 can be used for lending purpose. Let's compare them quickly. What is CRR and SLR? So CRR is kept with the RBI in cash only and earns nothing, while SLR is kept with the bank in cash, gold, and securities and may earn some returns and all. Now imagine RBI increase CLR and SLR. What will happen? Bank have less money to lend, loans become harder to get, economy will slow down. But on the other hand, if RBI reduces CRR and SLR, bank can lend more, businesses borrow easily, and economy will speed up. So both CRR and SLR are like the brakes and accelerator of the banking system. Okay, so far we have seen that bank can create money by lending, but do they always create the same amount of money? What do you think? I don't think so. The bank ability to create money depends on several factors. Let's explore them one by one. Take for example first one, initial deposits. Think of deposits as the fuel of money creation. Without deposits, bank have nothing to multiply. So if people deposit 1000 crore, bank can start the lending cycle. But if people only deposit say 100 crore, the base for multiplication would be much smaller. So the more people trust the bank and keep money with them, the greater the power of money creation. Again, CRR and SLR. The RBI control money creation by setting CRR and SLR. If CRR or SLR is high, bank keep more aside, there would be less lending and money creation will slow down. Similarly, if CRR or SLR is low, bank keep aside less aside, there will be more lending and more creation. So deposit of 1000, again we are taking that example with a CRR of 10%, SLR of 20%. So 100 goes to RBI, that's a 10% CRR. 200 bank need to keep in liquid assets. So what is left? 700. But in case RBI reduces the CRR by 5% to 5% and SLR to 15%, so bank can now lend 800. That is 100 more in lending power just by tweaking the ratios. Let's talk about the third case of public demand for cash, that is also called as the leakages. So here is something interesting. Bank can only create money from deposits, right? If people withdraw cash and keep at home, the bank exists. The money doesn't exist in the bank now. So economists call this as leakage. Say for example, it's Diwali time, so people will withdraw some money and keep in cash. So that money is not into the banking system, so it can't multiply. Lastly, would be the bank's willingness to lend. That is a confidence factor. Even if deposits are high and CRR and SLR are low, banks still need the confidence to lend. During uncertain times, say as a recession or pandemic, bank may fear defaults and prefer to hold cash or invest safely instead of giving risky loans. Suppose banks have 1000 available for lend. In normal times, they may lend 900 crore. Assuming that CRR is 10%, there is no SLR at that point in time. But in a crisis scenario, they might lend only 300 crore. So the actual money created would be much lower than the theoretical maximum amount. So let's recap. So CRR is money bank must park with RBI. SLR is money bank keeps in safe assets. Money multiplier is how deposits grow in many times the money supply. In our next video, we'll understand the concept of central bank, the functions of central bank, and difference between central bank and commercial bank. Until then, here's a challenge for you. Look at the current CRR and SLR rates in India. Do you think RBI is applying the brakes or pressing the accelerator on the economy right now? Put your response in the comment section below. Don't forget to like, subscribe to our channel. Thanks for watching. See you in the next video. Have a great day.